The head of Volkswagen's Workers' Council says the car giant intends to close at least 3 factories in Germany, leading to the loss of tens of thousands of jobs. Volkswagen has never closed a plant in Germany before. The announcement comes after VW reported a 14% drop in net profits.
Volkswagen Group, Europe's biggest automaker, is on a rapid decline. The company is so deep in debt and operating on lean profit margins that experts are warning that it could spell doom for the legendary automaker if nothing is done to address these issues. The situation's so bad and has been warned that it'll only take 2 years to turn around or face extinction. And that's not all. A whole lot of other issues are going on at Volkswagen that have shocked the entire industry after they were revealed. So, what's really going on at Volkswagen Group? Stay tuned! Volkswagen Group has just found itself in unfamiliar territory, one where it's experiencing a significant dip in profits. In the just-released financial report, the European automaker reported a 60% slump in profits before tax to $2.57 billion in the quarter before July and September, a massive drop from the $6.2 billion that the company recorded in the same period in 2023. Its sales for this period also recorded a 0.5% drop, closing the period at only $78.5 billion. Now, a minor sales decline of 0.5% may not appear drastic at first glance, but in a high-revenue industry like automotive, even a small percentage can translate to significant monetary impact. This slight dip in sales, combined with the substantial profit slump, suggests that Volkswagen may be facing pressures such as a slowdown in demand, possibly due to changing market conditions, evolving consumer preferences, or economic turndowns. But we'll come back to that later. Now, looking at the sales across the region, it's clear that the automaker is struggling in what could be a worrying indicator of what's to come. For instance, its sales in China for the entire 9 months of 2024 dropped by a whopping 12%, while sales in Western Europe fell by 1%. Overall, Volkswagen's vehicle sales fell by a staggering 8.3% in this period as compared to last year. Annually, the automaker expects global vehicle deliveries to drop to about 9 million units, a fall from the 9.24 units it delivered in 2023. Speaking about these damning figures, a representative from the automaker stated, "We need to state the situation is getting more serious." Also, the company recorded a drop in the sales of its electric vehicles, which dropped by a margin of 4.7% year-on-year. Volkswagen has blamed this on what it termed as the reluctance of the general industry to buy EVs. However, there could be more than meets the eye in relation to the reason that Volkswagen has given. And more bad news keeps coming for Volkswagen, its shareholders, and its ardent fans. An analysis of its books have shown that the company's total debt as of September 2024 has closed the $200 billion mark, now estimated to be totaling $219.94 billion. This means that only Toyota carries more debt than the European automaker, while companies like General Motors and Mercedes-Benz have debt levels that are up to 50% lower than Volkswagen. To get a clear picture of how Volkswagen got itself in this position in the first place, we need to look at a few factors. First, it's easy to see that Volkswagen is sinking deeper into debt with each passing year. Currently, the automaker is the most heavily indebted enterprise globally, and if everything goes according to its plans, it could solidify this position even more. This is after it became apparent that the automaker was considering taking up more loans to finance several operational aspects during this period. For instance, it recently concluded its first sustainability-linked loan totaling $1.4 billion. The interest rate of this loan will be dependent on how it achieves the European carbon fleet emission targets. The fact of the matter is, with such a low profit margin, the company might struggle to cover its interest payments and loan obligations. If profits don't increase in the short term, a larger share of earnings will go toward paying off debt rather than reinvesting in growth or covering other operating expenses. It goes without saying that this will only put Volkswagen at a more disadvantageous position in the industry. Volkswagen is also trying to find a way to cope with the recent policy change that has affected its EV sales drastically. Recently, the cash-strapped German government was looking for areas to tighten its belt. Unfortunately, one of the affected areas was the EV sector, where it scrapped a subsidy of up to $4,800 for the purchase of a new EV. This move has resulted in a significant decline in the sales of its EVs. The effect can also be seen in the numbers, where the automaker's EV market share has plummeted from 11.4% in 2023 to 11.3% in 2024. In addition to that, Volkswagen has been criticized for having its hands in a lot of pots that it becomes hard to juggle everything and sustain profitability. Key in point is the recent joint venture between the automaker and the American electric vehicle startup Rivian. Subject to this venture, Volkswagen agreed to invest $1 billion upfront and an additional $4 billion in what it termed as planned additional investment. This decision by Volkswagen did not sit well with many people in the industry, and the reasons for this are obvious. You see, since Rivian floated its IPO, its shares have plummeted significantly. As of the second quarter of 2024, it was reported that the company was losing about $1.5 billion per quarter, translating to about $30,000 to $45,000 for every truck sold in the last 5 quarters. Volkswagen's investment in Rivian and its existing struggles with debt and profitability has raised more questions than answers about its future financial health. Now, as it turns out, this deal was sealed in a controversial manner, with many top executives of Volkswagen being sidelined. One senior executive was even reported to have claimed that they learned about the deal from the news. As much as this might seem to be a small issue, it could have long-term implications on the reputation and long-term profitability of the company. Volkswagen is also in a position where it no longer has to worry only about its European competitors like Mercedes and BMW. Instead, its biggest rival now seems to be a completely different automaker located thousands of miles away. Enter BYD, currently one of the largest EV producers globally. Recently, Volkswagen's chief executive was quoted saying, "The automaker cannot keep up at the top of the table at the moment." For a long time, Volkswagen has been China's best-selling automotive brand. However, all this changed after BYD took over as the most preferred EV in the country. The woes at Volkswagen further increased after it became apparent that BYD is offering its unit at highly competitive prices that further push its way behind the Chinese behemoth. Now, what have all these problems at Volkswagen culminated to? The outcomes are beyond shocking. The first outcome that the European automaker has suffered is seen in the reduced profitability, as we have already seen. Now, Volkswagen sees no immediate end to this problem and has adjusted its projections. On October 2024, the company adjusted its projected operating result to $19.3 billion, this representing an operating return to sales ratio of approximately 5.6%. It mentioned that this move was informed by a deterioration in the macroeconomic environment that has impacted its operations negatively. To see how dire the situation is at Volkswagen, this was the second revision in as little as 3 months. On July 2024, the automaker warned of reduced profits following unexpected operating expenses totaling $2.8 billion. And in more shocking news, Volkswagen could be forced to close down its factories in Germany. The automaker has admitted that in a quest to remain afloat and turn things around, it could be forced to close at least 3 factories in Germany. This is a first for Volkswagen in its 87-year history, as it has never closed any plant in Germany. In doing so, Volkswagen aims to outsource many of its tasks and whole divisions to external service providers. The ripple effect of these closures is job losses. Now, the automaker's management is also reportedly looking to cut tens of thousands of jobs and reduce pay by 10% for the remaining staff. As expected, this is not bound to go unchallenged. Already, there are signs of looming strikes, and if this happens, it would sink Volkswagen further into financial problems. Apart from strikes, it's possible that Volkswagen might also be dragged to court by the union representing these workers, further making the already hard situation even harder. Now, it's a game of wait and see on how Volkswagen will juggle everything going on at the moment. Still, one thing is clear. Losing a major player like Volkswagen would deal a serious blow to the entire automotive industry, and we can only wish that it finally turns around for the better.